The stock market is rising. The bond market is going crazy. Real estate is off the charts. For those who own these assets, the appreciation has been magnificent. But for those who are only holding to take their profits, will they defy the odds of history and sell at the peak? Or will they watch everything come crashing down? You came here for the truth, so let me unveil that for you. Today, we're going to look at various indicators within the economy. Let's begin. Leading up to the financial crisis, we saw turmoil. The subprime crisis became the housing crisis, became the derivative crisis, and ultimately, Lehman filed for bankruptcy. It was at that moment where everything came tumbling down. In fact, in short order, the market tumbled 29%. You blinked once and your portfolio dropped 29%. That's what will happen again and again and again throughout all of these crises, because the market overreacts. But many people see this as a buying opportunity. Big mistake. The dead cat bounce shows us what will happen. You know, the majority of the 2008 decline happened in just a 5-month span. And that's a short period of time when you think about it. When you look back 5 months ago, feels like just yesterday. And nearly half of your portfolio would have been evaporated. But I think it's amazing to see a 29% drop in essentially, looks like a few weeks based on this chart. Nobody's prepared for that. Nobody wants to see that. And I would suggest to everybody to be very careful where you have your assets allocated in any asset class. Be careful, because in a moment's notice, this can drop. I don't think a lot of people realize that as things are normal, we have a lot of volume, there are buyers, there are sellers, but when the market drops, immediately everybody is a seller and there are no buyers. And that's something that I don't think people ever consider. They don't consider it during a market crash. They sure as heck aren't going to think about it when the market's booming. So just think about that. Now we have the Buffett indicator, the corporate equities to GDP, something I cover often here on this channel. So look at this. During the dot-com boom, 151%. Today is the only time in history where we have hit this level other than the dot-com boom. 134%. It beats the financial boom and bust and all the previous market cycles before. It shows us how far we have come in this regard. Okay. Looking here, I just wanted to show you the Nasdaq 100, all right? In the late 90s, it was suggested that things were very hot. Things are becoming crazy. The PE ratios are too high. The valuations are out of whack. Yet the market continued higher and higher. And it defied gravity. It was unknown when it would ever stop. But eventually, it did. And the market came down 78%. And it took essentially more than a decade for it to be restored. A lot of people tend to have that amnesia that, well, it is at record highs, but it also took, so many years just to get back to where it was. Let's not forget. Cumulative bull versus bear markets just looking at this very quickly, one of the points that I wanted to make here was that we have this very short period of time in here, and the market wasn't allowed to get back to restore order. They engaged in the most massive quantitative easing programs that the world has ever seen globally. Of course, it's a global concerted effort. Should they have given it a period of time to breathe and relax and rest, maybe we wouldn't be in the position we are today. We could find real investment out there instead of central bank investment. But that's not the way it is. That's not the way it works. And unfortunately, it simply compounds the problem. Stock buybacks. Look at this chart. Should this not explain what we are seeing here? These two are completely correlated. Since the financial crisis, stock buybacks and the S&P 500 are attached at the hip. And then this. The pace of buybacks among the S&P 500 companies is expected to have slowed this year. One of the points I want to make is that, well, of course, this seems to be true. Central banks have been picking up the pace on purchasing US equities. So they're just filling in the gaps. And the VIX, last but not least here. You want to look at this back from 1930. You could see that definitely we had some major issues going on there. There's no doubt. And the all-time high during the financial crisis, nobody trusted anybody. But you see, since that moment, they're essentially non-existent. There's no volatility. There is no way that this market could ever have any downside. That's what the VIX is telling us. And I think we need to be a lot smarter and need to pay much more attention. If you found this video informative, please give me a thumbs up. Last but not least, if you found the video informative, I know you will find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. If you go over to Amazon, they have a look inside feature. It's going to allow you to flip through the pages of these books to see if you like them. Take care.